I've taken it from 2020, which is really the start of the exponential age. We could take it from 2022. It's even earlier. And the Nasdaq's done like 3x. The Roaring Twenties did 4x in 7 years, but the 80s and 2000s did a 7x. The post-war boom is 6x. The industrial age was a 24x over an extended period of time. So we're still early in this. If it is a proper super cycle, which I think it is. I don't think it can't be more important than the industrial age or the post-war boom or the tech globalization boom. This is the most powerful technology the world has ever seen. It's the greatest discovery in all of humanity and will be the last discovery for all of humanity.
Something extraordinary is happening beneath the surface of the global economy. While millions of investors are obsessing over whether AI is a bubble, whether tech stocks have gone too far, or whether a recession is just around the corner, a much bigger story is quietly rewriting the rules of investing. According to Raoul Pal, this isn't another speculative frenzy that's about to collapse under its own weight. It's the beginning of an economic transformation so powerful that history may eventually divide itself into two eras, before AI and after AI. Think about the biggest wealth-creating periods humanity has ever experienced. The Industrial Revolution, the post-war manufacturing boom, the Internet Revolution. Every one of those periods created fortunes that seemed impossible at the time, because most people underestimated how long they would last and how profoundly they would reshape the world. Pal believes today's AI revolution belongs in that same category, but on an even greater scale. In his view, we're witnessing the birth of an exponential age where intelligence itself becomes the world's most valuable resource, creating opportunities that most investors still fail to recognize. That's why he argues we're nowhere near the end of this story. Despite explosive gains in technology stocks, despite record AI spending, and despite endless warnings that the boom is unsustainable, Pal believes the market is still in the early innings of a genuine supercycle, one driven not by speculation alone, but by an unstoppable global race for intelligence that governments, corporations, and financial markets simply cannot afford to lose. If he's right, the biggest investment opportunities may still lie ahead. In today's video, you'll hear Raoul Pal explain why AI capital spending may be impossible to stop, why the debt fueling this revolution could actually strengthen the economic cycle instead of ending it, and why he believes the exponential age is only getting started. If you enjoy deep macro analysis that helps you see where markets could be heading before the crowd does, make sure to hit the like button, subscribe to the channel, turn on post notifications, and let us know in the comments whether you think we're witnessing history or just another bubble waiting to burst.
So let's talk about this idea of a super cycle. I'm not entirely convinced we're going to see another business cycle here. We've got the largest capital build-out in human history. So we are spending an extraordinary sum of money on financing this. And that is going to be done by a number of ways: cash flows, debts, and other stuff. And we used to see things like semiconductors growing, in a cycle. They were very cyclical, between down 20% to up 40% a year growth that held for 35 years. And when this presentation was done, it was at 79%. It's now over 90% year-on-year growth. So we've got something entirely new that we've not seen before. And the cynical mind might say, you know what? This is just another malinvestment boom. And we're going to talk about that because I don't think that's the case. You see, one of the issues here is that we've got a weird situation that nobody can defect. Nobody can fail here because everybody has to run flat out because intelligence is compounding too fast. It's compounding so fast that if anybody falls behind, they can never catch up. So there's no equilibrium where it can slow because somebody will use the advantage to win. And if somebody wins, they get monopoly. So CapEx becomes a forced move and not a choice. Because if you don't, you're out of the race. And this is the biggest race of all time, the race for intelligence. It's a race of nations. It's a race of China versus the US. It's the race of model companies. It's the race between the frontier labs and the open source. It's a race that nobody can stop. And they will put more and more money into this. I even get to the point where people say, well, and we'll come on to the debts in this sector, But let's say one of the big players went bust. Let's say it was OpenAI. And everyone says, well, this is a disaster. Well, just play through your mind what would happen if OpenAI went bust. Somebody is going to buy all the compute and double the compute. And then they would be the monopolistic power, because more compute equals more intelligence, which means they scale faster. The US government, I don't think, can even allow that to happen, because the lab that gets it becomes so powerful. So it has to be kind of auctioned and split amongst others. So I find it hard to believe it's a malinvestment phase when somebody will find the money to buy any excess capacity, because it's such a strategically important move, because no lab can fail. So let's look at the size of the CapEx boom. So it's really not that big. It's big versus the post-war boom. And this is projections going out to 2030, about 23% of GDP. Nowhere near what China did in the 2000s or Japan did in the 80s. So we've got plenty of room to run. It's a big CapEx boom. It's a very big CapEx boom in US history, but it's certainly not gigantic. We've seen much larger booms in the past. And also, when we look at the returns of the cycle, we're early. So far, I've taken it from 2020, which is really the start of the exponential age. We could take it from 2022, it's even earlier. And the Nasdaq's done like 3x. The Roaring 20s did 4x in 7 years, but the 80s and 2000s did a 7x, the post-war boom is 6x, the industrial age was a 24x over an extended period of time. So we're still early in this if it is a proper super cycle, which I think it is. I don't think it can't be more important than the industrial age or the post-war boom or the tech globalization boom. This is the most powerful technology the world has ever seen. It's the greatest discovery in all of humanity and will be the last discovery for all of humanity. And we're just going to allow it to go bust? We can't. What people are looking at is the hyperscalers were pouring capital into this because they made more money than any other firms in existence. And then suddenly in 2026, the switch flipped, and now they start issuing debt because they want to go faster, because of the story I told you before. Speed is everything. He who gets the most compute wins. So what we're seeing is this hyperscaler race for compute. And they now spend more than their cash flow. And that sounds like it could be catastrophic. But really, these companies, they're extraordinary cash machines. And they can finance a lot. And over time, what you find is that investments in CapEx tend to lead to more profits. And when we look at the leverage of these firms, I'm always take the dumb idea of leverage, which is I just look at it as a percentage of market cap. And percentage of market cap, these things are only like 4.5%. The telcos back in the 2000s were, 25%, 30% of market cap in debt, with many of them at 100%. And here we've got nothing. As a proportion of cash flows, it's nothing. It's so low debt. And these guys have such an ability to service debt. Now, even if the advertising market changes and some of their business model changes, the likelihood is that they find new sources of revenue, which is whether it's leasing out the compute or selling intelligence in different formats. So I think that the game is still self-sustaining. Will they all sustain? I don't know. But over time, I think there's plenty of cash to do this.
Pal's argument completely flips the traditional investment playbook on its head. Instead of viewing rising debt as a warning sign, he sees the next phase of AI investment as something that actually injects additional liquidity into the global economy. The first wave of this infrastructure build-out was financed largely through enormous cash flows generated by the hyperscalers. Now that those companies are moving into debt financing, every dollar borrowed doesn't simply fund more data centers, it also expands liquidity, fuels investment, boosts productivity, and potentially accelerates economic growth. In Pal's framework, the AI race becomes increasingly self-reinforcing rather than self-destructive. But the story doesn't stop with big tech. If corporations are committed to financing this new era, what about governments and the broader financial system? That's where Pal believes the next chapter becomes even more compelling. He argues that public policy, bank lending, treasury financing, and monetary conditions are increasingly aligning around one objective: keeping enough liquidity flowing to sustain what could become the largest capital investment cycle the modern world has ever experienced.
Now, when we look at total debt to GDP, can the economy take much more? And the answer is yes. We broke the economy twice on debt. Once was in the 1929 and once was in 2008. And it's roughly when it gets over, let's say, 165% of GDP. We're currently total debt in the US about 140% because we've been deleveraging. Now, the changes in things like the ESLR and the bank mandates that are coming force the banks to lever up, to create money, so the public sector doesn't do it. Or it doesn't do it as much. So they need the bank balance sheets in this, and they've got plenty of room to expand total non-financial debt to GDP. So when we look out in the future, we have the ability to add another 24 trillion of debt to 2030 before we would hit that upper envelope. And that what it does is assumes about 6% nominal GDP growth, which let's say is 3 or 4%, 3% GDP and 3%, 2% productivity, 1% inflation, whatever the number is. I think that's probably low. The faster GDP grows, the faster you can actually increase the amount of debt. I think GDP actually grows faster than this, but I'm trying to be conservative. So you've got a huge amount of debt that is able to be issued by the economy. The economy can manage higher levels of debt. But what that means is we have the ability to triple the pace of debt growth that we've seen and finance by a lot of it the hyperscaler revenues and others. The size of this new cash into the economy is more than a Marshall Plan every 6 months. And it's all being rooted into one substrate: intelligence. It's an extraordinary concentration of capital into the biggest thing of all time. And we've already committed to the interest payments of 1.2 trillion. So financial conditions cannot be allowed to tighten because we've got to pay this. And if financial conditions tighten, interest rates go up and this number keeps going up and we have to pay for it via debasement or liquidity. So the sovereign side is committed to this. The corporate side is committed to this. Everybody is committed to adding more liquidity and spending money in the economy. Everything is now based on this. So just to recap, the treasury uses short-dated bills. That goes into the banking system and elsewhere. It's a cheaper way of issuing, and it means that there is less cyclicality, but it is an injection of liquidity. The banks, well, over time, they absorb more of the treasuries, and then they create lending on the back of it. They use it as collateral. So we will see, as the yield curve begins to re-steepen, the banks picking up their ownership of treasuries, which helps the treasury out, who have a lot of these bloody things. And then the other would be the Chinese, the Japanese, and others. And the Fed, now their main job is to get out of the way, is to keep interest rates below GDP growth. So they've got financial repression, and then get regulatory clearance for the banks to absorb massive amounts of debt, knowing that the economy can take this. And that's what the Fed are going to do. I think Walsh cuts rates a couple of times and steps out of the way, just like Greenspan did. Greenspan played the same playbook, which is let productivity lead, let growth lead. That's the bet. If that happens, all of this works. And the system is coalescing around this very big idea that the exponential age is going to drive productivity. If it drives productivity, then it drives GDP growth and lowers inflation. That lowers the interest rates, likely. On the long end, it certainly has probably a steeper yield curve. That allows the banks to lend. That allows the financing of the massive CapEx boom. And it also allows for the Treasury to roll its debts. So it's all connected and it's all part of the financing regime. And again, as we've said before, is this payments of interest payments It leads by 3 years, and we have to keep going. We have to keep going. So I don't see any path right now of which it slows down. And this is the reasons I'm starting to believe it's a super cycle.
Whether you agree with every part of Raoul Pal's thesis or not, it's difficult to ignore the scale of the transformation he describes. His case isn't simply that artificial intelligence will change technology companies. It's that AI is becoming the foundation upon which finance, government policy, productivity, corporate investment, and economic growth are all beginning to converge. If that proves true, then traditional business cycles may no longer behave the way investors have come to expect. Perhaps the boldest part of Pal's analysis is his belief that this cycle becomes increasingly difficult to interrupt. Companies cannot afford to stop investing because falling behind could mean permanent competitive disadvantage. Governments cannot allow financial conditions to tighten too aggressively because debt servicing and economic expansion increasingly depend on continued liquidity. Banks have incentives to expand lending, while productivity gains help support stronger GDP growth. In Pal's view, each piece reinforces the others, creating an ecosystem that feeds on itself rather than exhausting itself. Of course, no forecast is guaranteed. Markets will continue to experience corrections, volatility, and unexpected shocks along the way. But history has consistently shown that the greatest wealth is often created by identifying transformational shifts before they become obvious to everyone else. Whether this AI build-out ultimately rivals the Industrial Revolution or not, investors who understand the forces driving today's economy will almost certainly be better positioned than those focused only on short-term headlines. As always, the most valuable skill in investing isn't predicting every market move, it's recognizing when the world itself is changing. If Raoul Pal's supercycle thesis plays out anywhere close to the way he envisions, today's headlines may eventually be remembered as the opening chapters of one of the greatest economic transformations ever witnessed. If you enjoyed this breakdown, don't forget to leave a like, subscribe to the channel, share this video with someone following the AI and macro investing story. Thanks for watching, and we'll see you in the next video.